most people are going to say, I want to pay off my house because it's my biggest asset. You're always going to have property tax. You're always going to have maintenance. It doesn't pay you a thing. Your equity in your home is not yours. If you want proof, bring it to the office. You can't. The only way to realize the equity is to sell the asset or sell the liability.
Because most people's money's never really theirs. It's in their temporary possession. So if you pay me $100, let's say, you give me $100, most people think that's my $100 now. It's not, because you're going to eventually spend it. The thing I love about life insurance is you put that money into a policy, it'll never stop growing for you for the rest of your life. The compound interest is guaranteed, so that $100 is actually yours for the rest of your life with the growth, and then you can borrow against it.
CPA can say, I'm going to save you money on taxes. Just put 50 grand into this SEP IRA. I'm going to save you 10 grand in taxes. That's not a tax savings. And if you want proof, pull out the 50. Change your mind. Pull it out the next day. You'll owe tax plus penalty. What a racket. Isn't it funny? And then they come back at us like, oh, it's all about commissions. Do the math on a 401k, the fees, bro, over your lifetime. You think we're getting rich doing this?
401k was brought in to fix a problem that the government created. The government created too much taxes. So the solution that they're creating is to defer the taxes. Everyone always thinks when I talk about infinite banking, they're like, oh, he's an IUL guy.
I know. Why do people do that?
Does the market go up every year?
No, it went down 20 points 2 years ago.
So if it goes down 20 points, how much does that have to go up just to get back to zero?
25 points just to get to zero, let alone the growth that you expected.
Yeah, when you're 5, 6, 7 years old, the cost of insurance is...
Bro, it's nothing. You could totally overfund an IUL for a kid, and then when they're 18, move it into whole life. I think that's a good strategy. Are you using AI in your business yet?
Oh, yeah. So you have to use it, because it's like people that didn't adopt the internet back in like the 90s, they fell behind. So you got to adopt AI, you got to use it. Why do you feel like an IUL should never be used for IBC, infinite banking concept?
Well, number one,
This is the Mr. Burr Show.
Welcome back to the show, everybody. Today's going to be an exciting episode about something that you guys know, I know very well, which is life insurance.
Yay.
Insurance, infinite banking, right? Using life insurance as a concept of how to control your money. So we're going to talk a lot about that with a man that knows it very well. He's been very successful in the industry over a long period of time. His dad's in the industry. His dad's been in it forever. And we're also going to talk about how he's done that and also balanced family life. This man is a girl dad like myself, so I have a strong affinity for him because of that. It is not easy being a girl dad. He's got 3 of them. So we're going to dive into all about infinite banking. He's got a book coming out. We're going to talk about that. You guys should definitely get it. We're going to talk about how he's balanced everything he's doing and pouring into his 3 girls. So without further ado, I would love to introduce you to my good friend. Hello, how are you, buddy?
I'm good, Devin. Thanks for having me. I see what you did there. Love. There it is.
I had to throw it in. But for the people that really don't know about you, kind of give them a brief synopsis of who you are and what you do.
For sure, man. So I was supposed to be an architect. I went to undergrad and graduate school for architecture. I wanted to create beautiful buildings that last longer than we do. And I was really interested in community design and realized that a lot of community design or urban design, you work with government officials. And I got turned off pretty quick. And I also realized I wasn't going to be great as an architect. I worked for a firm that did super high-end residential stuff. And I saw the writing on the wall, man. My boss was really good. And I was good, but I wasn't great. And I saw the guys working in the office after like 10 years and they just kind of hated their lives. And I'm like, I don't want to be that dude. Went online. This is back when, 2009, Facebook was fairly new. And I was like, I need a new job. And a buddy of mine, kid I met twice, was like, come to Chicago and sell garages. It's like, I don't even know what that means. But I went to Chicago, hung out with him. And turns out he would, this is what I used to say, he would design the last room of the house that the man could call their own, the garage. So we would do car lifts, epoxy flooring, cabinetry, organization, make a man cave. And I realized helping people get what they want, you could really have impact quickly and you can get paid really well. I doubled my income in like 9 months from being an architect to that. And I was like, well, I want to keep helping people get what they want. And around that same time, a good friend of mine lost his mom. He inherited her IRA and owed a boatload of tax on it that he wasn't planning on paying. on top of his ordinary income. And that's when I saw what my dad was doing with life insurance. And at the time I had owned my own policies. I never thought about getting involved in the financial world because I don't like gambling. I'm not a stock market guy. You know, I'm an entrepreneur. I would like to believe, and I feel like I can have more impact in my rate of return in my business than investing in somebody else's business on Wall Street. So I never wanted to manage somebody else's money on Wall Street. But when I watched my buddy inherit all this money and pay this tax liability, at the time I was funding a 401k through work, you know, saving for retirement because you got to let it grow for the long run. And I learned I was doing everything wrong. So that's how I got involved in life insurance. I watched my friend overfund policies using his inheritance, and he's leveraged the policy multiple times. He just turned 40, and he's used that money that he inherited over and over again. And you contrast that with his mom, and all of her savings was in a retirement account. She never retired. She died at like 62 years old. Never spent a dollar from the retirement account. Taxable inheritance to the kid. It was horrible. So I was like, look, I can go help people understand how money actually works on the exit side and how to use it before retirement age. So I got into the life insurance game.
I love it. Talk about then how important it is to have control of your money throughout your life instead of tying it up into some retirement vehicle.
Well, so when I started, I would, you work in these agencies with, it's the pyramid. Every business is a pyramid, but you got the rich guy at top of the agency, and then you have all these minions that work, and all the money goes to the top. And what I was really fascinated with was, how do these financial planners make financial decisions for their clients? How do you know when to do an IRA? How do you know when to do life insurance? And I realized quickly that there was no process in place until I found LEAP, which is a great lifetime economic acceleration process. A great way to create a framework in financial decisions. And that's something that you can draw out and see. And it like, as an architect, it like made a lot of sense for me. But, the biggest problem that I saw with these 40-year-olds and 50-year-olds, their net worth might be high, but if you asked them to grab $100,000 and bring it to the meeting, they couldn't do it. Net worth is the number on a page. It's not, most people are more interested in cash flow, not just net worth. And so you see these people that have high net worths, but no control. And it's like, that's not the position I wanted to be in. So you get pushed back from the higher ups. They're like, you got to do everything for everybody. And it's like, no, I don't. If somebody wants to go overfund a 401k and pay off their house and be debt free and broke, power to you. But not everybody wants that. So I'll be the beacon for the people that don't want that.
Mm-hmm. I love it. So is that what the book's about? Let's talk about that.
Yeah. So the book, it's called The Entrepreneur's Asset. So if you're listening to this, you can go to theentrepreneursasset.com. And if you buy it through the website, you get free access to a financial course, and then you get access to the audiobook as well for free. So go to the website, check it out. But I realized, because I was spending I probably spent almost a decade in the retirement space, helping people retire. And that was frustrating because you get these people that are in their mid 60s who have been saving their whole life in an account that they've never used. They don't know how to turn it on into cash flow. And then when you teach them the solutions to how to have income that you can't outlive, or how to have, life insurance becomes an asset replacement strategy in retirement years. Now I have permission to spend my assets knowing that I'm not going to leave nothing to my heirs, whether it be my spouse or my kids. And when you teach a 65-year-old that, look, what you've been doing your whole life is going to be different than what you're going to do on exit, there's just a lot of education. There's a lot of the same type of meeting. There's a lot of what feels like convincing, and it gets old. And with entrepreneurs, I believe entrepreneurs think outside the box anyway. They have this chronic optimism that they can make things better. And the ironic part of the financial world, and I say this all the time, is that, financial planners, financial advisors teach clients how to invest in someone else's business on Wall Street through stocks. And you get a lot of entrepreneurs that have multiple 6 figures, 7 figures in the bank, doing nothing, going backwards with inflation. Why? Because they can control it. They get it. They understand that they want control. They'd rather double down on their ability to earn income rather than hoping the S&P does 10%, So the book is kind of like what I hope is going to be a permission slip for people to go, you can invest in yourself. You don't need a retirement plan to retire. You need cash flow. And it talks about the mindset of an entrepreneur and how we talk to ourselves, and then translate that into how do we talk to others. And then it goes over these financial myths that we think that are true, and it proves all of these things wrong. And then finally, it goes over how an entrepreneur can, overfund life insurance to create a death benefit for their family. And then they have an account that can be accessed for anything that they want without any red tape, no limitations, no age restrictions, no tax, none of that crap. So it's like a permission slip for people like, you know what? I knew there had to be, we question the vaccine. We question the government. We question schools. We question the food that we eat. It's about time we question the financial system. And hopefully the book will help people understand that.
100%. Well, let's dumb it down for people. Some people might not even know the difference between like an asset and a liability.
Yeah.
That's the problem, I think, is these things aren't taught in schools. A lot of people they don't know the difference. So asset and a liability, let's just start there. What's the difference?
Great question. The way that I define these is that a liability is something that I pay for, and an asset is something that pays me.
Perfect.
That's the easy way to look at it. So, if I have a rental property that's someone's renting out, that would be considered an asset. Now, let's get the Dave Ramsey and the Grant Cardone fans on this. And what about my house? My house is somewhere that I live. There's equity in my home. Is a home considered, what would you consider a home, an asset or a liability?
A primary residence?
Yeah, primary residence.
It could be both. So that's where it gets a little confusing for people. So if you just live in your house and you're paying your mortgage, it's a liability. It's taking money out of your pocket. Like you were saying, it's something you're paying for. However, if you live in your house and you have people renting rooms and they're paying you enough to cover your mortgage and some, now it's putting money in your pocket.
Yeah.
If you leverage your equity and you take it to go make more money than your mortgage payment, it's now an asset. So it could be either.
You got it. And most people don't look at it like that. Most people are going to say, I want to pay off my house because it's my biggest asset.
Yep.
Well, you're always going to have property tax. You're always going to have maintenance. It doesn't pay you a thing unless you do a reverse mortgage, which is a topic for another day because that's a great idea for some people.
Great idea. If you understand.
If you understand, it's a great idea because debt is tax-free. But yeah, so a house, the way most people use it, a house actually is a liability. Now, it can have equity, but equity is on paper. Here's something that's interesting. The equity in your house is never yours. It's not yours. Your equity in your home is not yours. If you want proof, bring it to the office. You can't. You have to go to a third-party lender, maybe open a HELOC, home equity line of credit, ask the lender for their money, and then use that. But even a HELOC, when you pull the equity out with a HELOC, the lender's going to want their money back. It's not your money. The only way to realize the equity is to sell the asset or sell the liability, which is funny. So
about this, I've always had this thought is, I agree with you 100%. So it's not your money. It's the bank's money, and they're just using your house as collateral to give you the loan.
Yeah.
It's not your money. You sell the house and you get all this money. It's now your money, but it's actually not. It's just in your temporary possession.
Yeah. You want proof? Don't pay it back. Watch what happens. They're going to come and take it.
Right.
You better give that money back, dude.
Right.
And who knows what the interest rate will be. Like when I got my house, I had a HELOC. It was at 4.2 because jumbo rates at the time were higher. Well, the HELOC is a floating rate. That jumped up to 10. So, it's expensive to get money right now. But yeah, that money it's not mine. It's the lender's money, and they're going to want that back.
So this is one thing that I love about life insurance. You will agree with this. I'm positive of it. Is that money is never really yours. Most people's money is never really theirs. It's in their temporary possession. So if you pay me $100, let's say, you give me $100, most people think that's my $100 now. It's not, because you're going to eventually spend it, right? Most people spend it as soon as they get it.
Mm-hmm.
The thing I love about life insurance is you put that money into a policy, it'll never stop growing for you for the rest of your life. The compound interest is guaranteed. So that $100 is actually yours for the rest of your life with the growth, and then you can borrow against it.
And when it comes to like FINRA and securities and financial planning, there's a reason I never got licensed to be a financial planner. Not because I couldn't do it. It's because the money can go backwards. You're not allowed to say the word guaranteed very often when it comes to financial. Right. And we can say guaranteed in life insurance, which in other words, I don't have to apologize for an account going down. And when you understand compounding, like you said, it compounds forever, even when I use the cash. So if you look at it, like I say all the time, I'd rather have equity in my life insurance than equity in my house. Because the equity in my life insurance, I don't need an application. There's no repayment. When I pull the money out, there's no repayment structure that I have to make like on a monthly basis. And if I die, my wife doesn't get stuck with the mortgage. She gets a tax-exempt death benefit, less whatever I borrowed and plus the interest. So I guaranteed success for my heirs. Now I have a true permission slip to go leverage that for other people or for other investments.
Let's talk about those things because I want to make sure people get those. Is first thing, how is it guaranteed? How can they guarantee you an interest rate? Let's cover that first.
The insurance company guarantees the growth, and then you get growth on top of that based on the profit of the insurance company. But the insurance companies are guaranteeing the growth based on their portfolio and their history. Insurance companies are very profitable. I think everybody knows that. I always, what would Geico's save 15% in 15 minutes? Well, how much would I save if they didn't spend so much money on ads? Could I save 30% if you just don't advertise in the Super Bowl for a couple of years?
Right.
So life insurance companies are very profitable. And if you look throughout history, you can Google all this. Like banks, dude, thousands of banks have failed in the last couple decades. Life insurance companies don't fail nearly as often. And I'm reminded of this one a few years ago that demutualized. So we use mutual insurance companies because I can share in the profit of the insurance company. And then they give me a dividend tax exempt. Because it's a mutual company. As a policy owner, it's mutually owned by the policy owners versus being a publicly traded company that has stock on Wall Street. Well, this company went from mutually owned to privately held, which means they don't need the policy owners no longer share in the growth. All the contracts that were enforced are still keeping the guarantee of the original contract, which is around 3 or 4% growth. That's an example of an insurance company completely changing directions and the policyholder is still taken care of. Still can't go backwards.
Contractually, it is guaranteed
by the insurance company, and the insurance company could go belly up. That doesn't happen very often, and you can Google this too. What happens typically is that the insurance company would be purchased by another insurance company, so it'd just be swallowed up into the assets of a larger corporation. And you're talking about multi-billion-dollar companies that have been around for literally over a century.
So that's how they can guarantee it. Now let's talk about, so when you borrow against your cash value, because that's what it is, I always liken it to a house. Most people can understand this, is when you make payments on a house, you build equity.
Yeah.
And then you can leverage that equity like we talked about. Go get an equity line of credit. You can now leverage that equity for whatever you want. There's no taxes. The difference is you have to be approved, right? You have to go through a credit check. You have to give
Prove income.
Right.
Prove income. Yeah.
So those two things you don't have to do with a life insurance contract.
You have to repay it.
Yep, you have to repay it. So life insurance contract, you don't have to repay it. You don't have to show financial statements. You don't have to have your credit pulled.
It shows up on your credit report. Like a HELOC will show up on your credit report as debt.
This doesn't.
Life insurance doesn't. It will affect your ability to get a loan. A HELOC will affect your ability to get a loan elsewhere. Life insurance won't because it's non-reportable.
So let's talk about then why you don't have to pay it back.
Okay. Easy concept, dude. When I buy insurance, this is the catch for everybody that goes, oh, it's too good to be true. No, it's not. You have to be healthy. So if I can get approved, the insurance company is going to give me a death benefit that they're going to pay out at a later date. All I'm doing is going to borrow against that future payout up to the amount of cash value that I have. That's it. So my death benefit is a guaranteed benefit to my heirs when I'm gone. I can borrow against that death benefit up to the amount of cash value that I have in any given year. And if I die with that loan outstanding, it's just reduced. The death benefit is reduced by the amount that I've. And think about people paying off their house. They're gonna give the house to the kids, which is great because you get to step up in basis. So there's no taxable event technically, theoretically, most of the time. But why not give a death benefit, which is substantially higher than the value of the home? I would rather give the house to my family, and they can sell it, they can stay, they keep it, they can turn them into rentals, they can do whatever they want, but they're going to get an influx of tax-free cash. Now they have power to go do stuff with that inheritance. So I'm leveraging my dead self while I'm alive in a loan that's non-reportable that I didn't have to show income to get. And I can go invest how I see fit. That's what the book's about, bro. It's like, you've never been taught this, and here's why. We get paid a commission to put a policy in force. We reduce the commissions, maximize the cash value. Easy concept. If I wanted to get rich as a financial advisor, I would manage pre-taxed accounts. Bro, advisors are charging fees on money that has to go to the IRS at distribution. And the consumer doesn't know any better. I got $1 million in my IRA. No, you don't. Pull it out. Pull it out. You're not going to have $1 million. You might have half. By the way, the advisor's charging you a fee on the full million. They see the pre-tax money as income. If I wanted to get rich, I would manage pre-tax accounts. That's what a lot of those big firms do. Swallow up IRAs, 401ks from companies. How often, you haven't been part of like a financial firm really, but the financial firms, these asset managers would talk about how they're going to get a big account, a company with 13 employees. That means there'll be 13 people saving for retirement. They know that those 13 people aren't going to use the money until they're 60. So it's years of income. Dude, it's crazy. It's the oldest way to get paid in the book. It's a fee, a quarterly fee. Regardless of the performance, the advisor gets to take their share. No share in the risk. They get 100% of the payout. Charlie Munger was talking about that.
It doesn't matter.
No, it doesn't matter. Charlie Munger and Warren were talking about, no, who was it? It was the Vanguard. The guy who started Vanguard was talking about that. The people that really won are the ones that are managing those pre-tax accounts because they're not taking any risk. They're just going to get paid every quarter. And they know that the consumer's not going to pull the money out.
And then how much sense does it make to defer your taxes? That's kind of like I look at like these programs like 401ks. The 401k was brought in to fix a problem that the government created. The government created too much taxes. So the solution that they're creating is to defer the taxes. Put your money in here, you get a deferral so you can drop a tax bracket, whatever it might be.
Yeah.
Why would you defer taxes when you know what they are?
Well,
and in the future, when you have no idea.
I don't think that it's a thought out strategy by the consumer. And it's a very easy way for a CPA or a financial planner to look like they're saving the day. CPA can say, I'm going to save you money on taxes. Just put 50 grand into this SEP IRA. I'm going to save you 10 grand in taxes. That's not a tax savings. And if you want proof, pull out the 50, change your mind, pull it out the next day. You'll owe tax plus penalty. So the CPA, because CPAs are historians, let's be honest here. They look backwards and say, what did you do throughout the year? What can we deduct? Moving forward, we'll just throw money into a SEP. We'll defer all the tax. And then he introduces the financial planner, comes in with a parachute. Yep, I'll manage it for you. All 50, even though if you pull it all out, you're not going to get 50. I'm going to charge a fee on the 50. And we'll talk when you're 60. By the way, let's hope the market goes up.
Fingers crossed.
Fingers crossed, dude. No skin in the game. What a racket. Isn't it funny? And then they come back at us like, oh, it's all about commissions. Do the math on a 401k, the fees, bro, over your lifetime. You think we're getting rich doing this?
Right.
It's crazy.
Is what we're doing, guys, full transparency. I've told this to my clients. I'll literally tell them how much I'm making on a policy. And the way it works, guys, very simple, is a regular whole life insurance policy is base premium.
Mm-hmm.
So base premium is what gets you the death benefit. Like the higher your base premium, the higher the death benefit. So I just said it. All we're doing is we're lowering the death benefit. We're lowering the base premium. We're lowering our commissions. And then we're having you overfund it with what's called PUAs, paid up insurance. It's basically you're getting a little bit of life insurance, but a whole bunch of liquidity. I think it's about 94% liquidity. So there's like a 6% fee for every dollar you put in because it's paying for a little bit of life insurance. So we don't get that commission off that. It's very small. We're lowering the base, overfunding, so you get liquidity. You're getting a little more death benefit. You're getting a whole bunch of liquidity.
Yeah, and there's zealots out there, and you got to be careful with like absolute statements. because sometimes it does make sense for people to have a little more base. I look at it like base is rewarded with higher dividends long term. PUA is early cash value, but not as much long-term growth. So if someone's trying to use a policy as an exit strategy, it might be like a 50-50 blend. And you can prove this with illustrations and stuff. But yeah, the for younger people getting started, it's like as much as you can goes into the PUA. I was making a video today, how to get 100% rate of return on my bank. So when I put money into the bank, I don't make much rate of return. There's like almost nothing. Well, by year 8 in a policy, if it's structured correctly, if I put 10 grand into the bank or into the policy, it's going to grow to $20,000 in cash value. That's like 100% cash on cash. And then I call the insurance company and say, hey, I want to take that out and go invest into a rental property. 20 grand. I put in 10, I take out 20, like that year. So properly structured is definitely important. There's tons of ways to do it. They're all different. But yeah, that PUA is what's going to give you control immediately. And then it's up to the consumer to get the rate of return. Right. If you think about this, if like most employees that fund 401ks, try to pay off their house, do everything that they're supposed to based on Dave Ramsey's recommendations, they are in absolute no control over their financial world. To the point that even the returns that they're getting in the market, whether it's positive or negative, is the responsibility of somebody else. They could pick a target date fund. Look at the fees on the target date funds. It's unbelievably high on a target date fund. There's so many hands in the cookie jar. By the time the consumer actually gets their return, it's not nearly what was reported, what they're supposed to get. And so these employees or the employee mentality is like, I'm just going to keep working hard and fund the 401k. It'll go up. Careful. That passive mentality, you're going to wake up at 65 and go, holy cow, this did not work how I thought. If the market worked like math, there would be a lot more millionaire retirees walking around right now. And yeah, the 401k was brought out by the guy that's known as the father of the 401k. You can Google this too. He created a monster. He never intended that to be the sole retirement source of income, right? But it blew up because advisors love managing pre-taxed money.
Yep. I mean, if you guys really stop and think about it, with a 401k, this is statistics. You can look this up. The average 401k at retirement is somewhere around, I think, 300 to 350,000. That's the average what someone has amassed over their working life at retirement. They're 60 years old. They want to retire. They got, let's even go high end, 400 grand.
Yeah. Okay.
And that's average, which again, for you math geeks, is higher than the median value of what it is. So just the average. So if that's what they have, and then the average household income is about 70 grand in the US, think about that. You've got $40,000 pre-tax and you've been living off 70 grand pre-tax. How long can that last? Not very long.
Not very long at all. And who's going to save you? And who's going to save you? Social Security? Yeah, right. Social Security becomes taxable at that amount of income too. The amount of it's 85% of your Social Security becomes taxable if your income, married, filing jointly, is over $44,000 a year, and half of your Social Security benefit goes into that calculation in the 44 grand, not set to rise with inflation. It's not. It's gonna. So they're going to try and fix their Social Security is broke, and they're going to try and fix it by what? There has to be massive tax in the future. So to your point earlier, why would I defer a tax? I don't think people understand what they're actually doing. They see this gross value in their account. They're dumping 50 grand into a SEP IRA and they got, 1.7 million, and they're not going to spend that much. I had a client one time. I said, look, if he had a money manager, which was a family member of his, which we found out a few years later was actually stealing money from him. And, but year before he found that out, he's a good dude. He's a dentist. I was like, look, I'm not saying what you're doing is bad, but if you keep doing what you're doing, he's going to have like $3 million in this account and he can't use it till he's 60. She goes, what's wrong with that? I said, pull it out. What good is $3 million? Do you care about asset value or cash flow? Never understood it. But then I found out that she was making money on the back end with that whole deal. So I think it's the consumer's naivety. They just, you put a couple of acronyms after someone's name who's a financial planner. You think that they know what they're doing, and they might not be doing it maliciously, but it's a horrible exit plan. And for guys like you and I, why do I want to wait 25 years to actually use my money?
I want to use it now.
I want to use it now. Bro, you cannot save enough in dollars to create an income that you'll be happy with in retirement. You have to have other assets.
It's impossible. You can't. And Dave Ramsey always says, save, 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 save.
Because he says you're going to get 12% every year. Again, if that worked, there wouldn't be broke people in return. You wouldn't have greeters at Walmart if you got 12% every year.
Right. Let's talk about then. Everyone always thinks when I talk about infinite banking, they're like, "Oh, he's an IUL guy."
I know. Why do people do that? You get that all the time.
So IULs, guys, an index universal life insurance policy, and everyone pushes these as an infinite banking policy, which infinite banking is a concept. It's not a product, for one. And the creator of the concept, the late R. Nelson Nash, he said IUL should never be used for infinite banking. Let's get into why that is. Why do you feel like an IUL should never be used for IBC, infinite banking concept?
Well, number one, I think it's kind of like an annuity. It's incredibly difficult for the consumer to understand how they're actually built. Right. And when you look at when they came about and why they came about, you start to understand why you just don't need to use it. IULs started in the late 70s when interest rates in the market was doing very well. So you saw people dropping their whole life policies to go put money into index funds, or CDs were paying 9% in the early 80s, right? So people were dropping whole life, and these insurance companies were scrambling, like, how do we get the market share back? What people should have done in hindsight is borrowed the cash value from the whole life and then went and bought a CD. That's what they should have done. And then paid the tax on the growth of the CD, but they're still getting the rate of return that they wanted to get. Because that compounding from the whole life that they dropped would have been outstanding 30 years later. They blew it when they did this. So the insurance company created universal life insurance to remove the risk from the insurance company and put it all on the consumer. So the insurance company says, all right, we're going to basically charge you term insurance in the background every year with an asterisk. By the way, we can change how much we charge you. That can go up over time, which it has. Google Transamerica. And we're going to let you chase the market. So we'll credit you the index. Whenever the index goes up, you can share in that up to a certain level. By the way, if the market goes down, you're not going to lose money. Oh, by the way, we're still going to charge you cost of insurance and fees and surrender charges, but we're going to tell you that the policy is not going to go down in value. So it basically puts in this extra level of risk to the consumer that I just don't think that you need. If you want to go buy an index, go buy the index. Leverage the cash value to go buy the index. But my foundation of my financial plan should have guarantees that will never be changed. The insurance company cannot change the cost of insurance in whole life. There's guaranteed growth inside of whole life. I get dividends from the insurance company, which has been profitable for over 100 years inside my whole life. I just don't have to worry. So IUL is like, it's extra risky, and they sell it with this sexy, it's returns tied to the market with a floor of 0, all inside an insurance wrapper that, doesn't trigger any tax. That's all the consumer hears, and they don't understand the risk that's involved, in my opinion. And I think it's kind of shoddy for advisors to push it so much on people, because it's a lazy way to teach people how to get involved in insurance. It's a lazy way for people to buy policy.
And it's extremely, extremely profitable for the insurance company.
Well, they love it.
So the commissions are very high.
Yeah.
And here's what I always tell people is, like, it illustrates really well. If you show an illustration for an IUL, an illustration for a whole life, the IUL on the non-guaranteed side will crush a whole life every day of the week, because they're
using a calculator.
Yeah, they're showing a return of, let's say, 7-8% every year.
Every year.
Does the market go up every year?
No, it went down 20 points 2 years ago.
So if it goes down 20 points, how much is that to go up just to get back to 0?
25 points just to get to 0, let alone the growth that you expected. So you're exactly right. The illustration is a calculator, linear returns, which is not life. And boom, people think they're going to buy that and have this great thing. And then it's seldomly overfunded like it needs to be. So they usually blow up on people. And then grandma and grandpa can't afford the cost of insurance when they're in their 70s. So it blows up on them when they're 70. IUL, here's where I think it makes sense, though. So you tell me what you think on this. for kids under the age of like 7, 10 years old, tie returns to the market. They have no exit coming up. You know, they're not even out of high school. Put money into an IUL. Hopefully the market continues to do really well. They could do well for the next 15 years. And then when they're 18, transfer all that 1035, that cash into a whole life policy so they can stop playing the game.
I like that strategy. Yeah, if you're young, 100%, because the cost of insurance is so freaking low at that point. And to your point before, it's tied to a 1-year renewable term. So every year the term insurance gets renewed. What happens to us every single year? We get older and better looking. Every year we get older, we're more likely to die. So the cost goes up. But when you're 5, 6, 7 years old, the cost of insurance is,
bro, it's nothing. You could totally overfund an IUL for a kid, and then when they're 18, move it into whole life. I think that's a good strategy, but
I never thought of that, and I might actually end up doing that for my daughters now.
I know. You're welcome. I'll write the policy for you. Just call me. I'll send you the application.
Put me on the case at least. Come on.
There we go.
Come on. Another thing I don't like about IULs, and agree with me on this, I know you're going to agree with me on this, is, again, they illustrate well. If you look at the non-guaranteed side, the non-guaranteed side is growing every single year at 8%. Non-guaranteed side of a whole life is based off of dividends, and they use the dividends that have happened before. Dividends have been at the lowest they've ever been. So most likely, the non-guaranteed side of a whole life is going to be better in time. With the guaranteed side on an IUL, it goes to 0. It's guaranteed to go to 0.
Yeah.
Guaranteed side of a whole life is guaranteed to do one thing.
Compound.
And those go up.
Yeah.
Every single.
That's why I don't, for my foundation, like as an architect, the foundation is the most important part of a building. So if I look at my financial world as a building, the risky stuff on top, if that crumbles, I still have the bottom. I still have my foundation is just fine. All I'm doing is replacing my bank, taking care of my family, and then leveraging that cash value into cash flowing assets. Why on earth would I want to introduce risk into my foundation? I don't need to. It's unnecessary. For a potential little bit more money, bro, not worth it. Not worth it at all. It's the market. When the S&P went down 20% in 2022, I put in like 60 grand into my insurance policy, turned into almost $100,000 overnight. Why would I not just keep doing that? Bro, I'm greedy, but not that greedy. That's, it's crazy.
Guys, re-listen to that last minute or two. What Matt just said, people think of life insurance as when you talk about it, they're like, oh, it's the dumbest thing ever. Like, I put over $700,000 a year into life insurance.
You make a lot of money, Devin.
I do well, but it's the thing about it is people have to understand that's me. That's my situation. I can put that much in. Not everyone can do that. What can you put in? That should be where your money goes first.
Yeah.
Not indefinitely. It should be the foundation where the money goes first. And now it's the foundation of your assets. So you've got the money here. It'll never stop compounding and growing. It's guaranteed. Then you use it to invest in other things that have risk.
Yep.
Right? But if you're investing in things you know, like, and understand, you're hedging the risk. Right?
If I make money and I put it into my bank and then I go invest in a rental syndicate fund or something, and the property fails, I've lost all my money.
Right.
There's fraud going on and everything's gone. My wife's going to kill me. My kids are mad at me. I feel depressed because I've failed. Now contrast that to, what if I just put money into a policy? Bought a big death benefit for the fam. Leverage the cash to go invest into a property. Property fails. I lost my money. I still have my death benefit. And I still have the value of what I borrowed inside that policy compounding as if I had never touched it. And I look at this as a learning experience. Now my job is to refill that void that I've created in my policy through income or some other investment. And I've given myself permission then to go try things. And, you get experience. And experience is what you get when you don't get what you want. You're going to get experience in life. And the faster you can learn and get experience with financial decisions, the better. Because not everything goes up. And so the insurance is a perfect place. It just replaces the bank. It doesn't replace my investment strategies. That's all it is, which is such an easy concept to understand. Just get out of the banking system. They don't. How many entrepreneurs hate banks anyway? From calling loans to floating rates to, oh, we see you have $100,000 in your checking account. Why don't you come and meet our preferred financial advisor? He's got like a $3 suit on and a clip-on tie. They don't know what they're doing.
They get paid commission to sell you a product, and they're going to sell you the thing that gives them the most commission.
Yeah.
And they have no assets.
This is what I think is funny too. A banker, dude, if you go into a bank, now there's cool people that are in banking, don't get me wrong. They're making 60, 70 grand a year, and they're talking to people making a lot more, worth a lot more. Why would we listen to that?
Right.
They're just selling widgets, man. I mean, I've had family members in banking. They're not. I have a hard time getting a job somewhere else. I'll tell you that.
Here's what I always compare it to is any advice you're getting. It doesn't matter if it's financial advice, advice on your diet, advice on your relationships, any advice. You should only take advice from someone that you would gladly trade places with. So if you're taking financial advice, and let's say you're making $250 a year, $300 a year, and you go to a financial advisor and they're making $70 a year, why would you take their advice? Like, you're doing better than them. If you go into the gym and you're in better shape than the trainer, why would you take his advice?
Yeah, it's a big red flag, especially in the.
Makes no sense.
Yeah. Yeah. Let's talk about family, because you have a new addition to your family, don't you?
Yeah, man. She's 8 months in about a week, which just is crazy. She got a little tooth coming in. She's crawling everywhere, saying mama, dada. Just a freaking blessing, man. And I touched on the beginning. So I've got 2 daughters. One is going to be 17 this year, which is freaking crazy. And the 8-month-old. Let's talk about yours. What are the ages of the girls?
Well, so to back up, I skipped my first wife and just married my trophy wife when I was older. And so we've been popping out babies. I have a 5, a 3, and a 1-year-old. And they're adorable, dude. The 5-year-old, she'll put on 3 different outfits before 9 a.m. Hands on her hip and super feminine and dancing, and she's hilarious. The middle one is like my twin, huge blue eyes. She's just the funniest. She's got a sweet personality. And then the youngest is kind of coming into her own. She had some problem when she was born. She had pulmonary hypertension, which is like extra pressure in her lungs. And so she wasn't retaining enough oxygen. So she had to be on oxygen for a while and an NG tube, and it took forever to diagnose. And man, that'll give you an opinion about the medical industry. I'll tell you that. Going to the NICU for almost about a month and a half and dealing with these physicians. It's crazy, dude. Especially when you look at like the vaccines and how much we're giving these little kids, and what's in food, and just, there's so many rabbit holes you can go down. So, but what I made a decision, when Penelope, the youngest, was born, we were in the hospital all the time, and dude, it's hard. How do you run a business? How do you make money when you're taking care of all these people? So it's been a difficult year, but dude, I wouldn't trade it for the world. It's like freaking amazing.
Mm-hmm. So how do you do that? Let's get into that a little bit. How do you balance having 3 daughters with running your business?
You have to be a master of your own time, and God knows I can improve on my own, but that's what I really try and strive to be a master of the calendar. If I don't rule my calendar will rule me. And every day on my calendar, 4:00, there's no more meetings, no nothing. I'm going to be in the car at 4:30 on the way home. And over the last year, it's been incredibly difficult to find time to go to the gym and get in shape and stuff, which I still think is very important, because there's like a pyramid of success in my mind. In order for me to take care of my family, I have to be able to make money. Well, in order for me to make money, I have to be healthy. So at the end of the day, the most important thing is me. I have to take care of me. And otherwise, I wouldn't be able to take care of everything else as well as I could, which is it's a weird epiphany to have. Like, to make time for yourself when you feel like you should be at home. And so I've struggled with that over the last year, feeling super guilty leaving to go take care of me, which is very, very hard. And I don't know how our wives do this stuff, dude. I could not raise 3 girls on my own. Holy smokes. So you got to be a master of your calendar. And like the last year, the youngest, she'll get up early. So I get up early and I don't have anything on my calendar start before 10 a.m. So I'm only working like 6 hours a day. And if I can get into the office sooner, I will. But bro, since Lilo, the oldest, was born, I think I've missed putting them to bed maybe 3 or 4 times.
That's beautiful.
Yeah. I give them baths. I wake up with them. I put them to bed. It's awesome. You'll never get that back, dude. You think I'm going to regret that when I'm 60? No.
You can make more money. You can't get time back.
Never.
Nope. Cannot do it. I'll tell you this much. Enjoy every last second of it, because there's this thing with daughters. They are daddy's girls. They'll cling to your side. They'll hold your hand everywhere. They give you kisses. I love you, daddy. I love you. I love you. They do all of that until they don't.
Mm-hmm.
And that for me was around 12. And same thing. I used to tuck my daughter in every night. I'm working one night and she comes into the room. She's like, I'm going to bed. I'm like, all right, I'll be there in a second. She's like, you don't need to. And I'm like, what do you mean?
Yes, I do.
He's like, I can do it. It's fine. You don't need to tuck me in. I'm like, oh, I'm tucking you in. I'm coming in there.
Yeah.
But like, that was like kind of the turning point, man. And it's crazy how time flies. And it gave me perspective because, dude, when I was young with her, I was 22 when she was born. I'm like, you don't have any concept of time when you're 22.
No.
Now I blinked. She's almost 17. And I blinked. My new daughter, Brooklyn's almost 8 months. And it's like, I got to freaking soak up every second with these little girls. Because when my daughter's out of the house in like a year and a half, right?
Then it's just weekends. It's just weekends, maybe once or twice a month, man. So I'm really big on, number one, making sure I'm there. And when I'm there, like not on my phone and stuff too much. My wife's listening. She's probably laughing because I am on my phone sometimes, but I'm very big on vacations, completely disconnecting so that we can come back fully recharged. And my family does a thing in the summertime. They have a family cottage up in northern Michigan. So we just got back from like a 3-week trip. Bro, I trailered the boat up there. We were on the lake. Literally, I think there was 2 days we didn't get on the water because it was raining. But tubing, I took the girls surfing, swimming at the sandbar, goggles, swimming off the dock. It was incredible. And then I got back to work and I was stoked. I had a phenomenal week. Last week was my first week back from the vacation. Got a ton of stuff done. So like being the master of the calendar means that you plan for the time off, just like you plan for meetings. And you have to hold that, stick to that. The gym time is on the calendar. I got to be flexible with the baby. So that's the hardest one that gives, honestly. But with time off and time with the family, like for the weekend, no negotiation. Yesterday I went to the pool, it's the way to do it, bro.
I love that, man. You hit it right on the head a little earlier with if you don't have your health, you really can't show up to your fullest with everything else. So I absolutely make it a priority to go to the gym every single day. I want to live a long time, dude. I have this goal. And some people think I'm crazy for this goal is I want to live to see my daughter, Haley, my oldest, reach 100. I want to see her be 100 years old. That would mean I'd have to live until I'm 122 at least.
Nice. Well, be ready to pay a tax bill because your policies will endow at 121 and you're going to get a huge tax bill when you're 122 years old. But I hope you make it.
I won't, though. I won't get a tax bill because I've got them going into a trust. So there's, and no one quote me on this because I'm not a tax attorney, but this is what I've been told is there's estate taxes, there's income taxes. So when a death benefit is paid out, there's no income tax, but there's estate taxes over a certain point. I think it's 21 million. I'll have way more than 21 million at 121 because of how these are structured. But there's no estate taxes going into this complex trust.
Right.
So yeah, there won't be any taxes. And then,
Well, I was saying, like, if a policy endows, then it is taxable. If you put it into a trust, I don't know about that legality there, but it's not like a tax-free death benefit that goes into the trust. It's a taxable amount because it endowed. That's why I said, dude, policies used to endow at age 100, and then they raised it up to 121 because people were actually living to age 100.
yeah.
And hell, even down the 90s, in the 90s, back in the 80s. So they kept raising it because of medicine is prolonging life.
Yeah, maybe they'll raise it because AI is going to prolong life.
Oh, bro, you're going to put a USB in your head. We'll be living to 150. We're going to be a computer screen.
Yeah, unless AI kills us off before then.
Amen. Are you using AI in your business yet?
Oh yeah, I use ChatGPT like it's going out of style.
I love it, dude. Yeah.
So you have to use it because it's like people that didn't adopt the internet back in like the 90s. They fell behind. So you got to adopt AI. You got to use it.
Yeah. And I laugh at
right now, read this book for everyone that's kind of interested in AI, and I would suggest you read this too. It's amazing. It's The Coming Wave. It's
WIVE.
Let me see who it's by. I forget his name, but he's like one of the founders at Google that like really, really started like diving into the AI and creating it. It's by Mustafa Suleiman.
I've heard of this guy.
It's crazy.
Yeah, I think that's a good read. I'd like to get into that.
A long book, so be prepared. But what would you to finish this on? One, how can people get a hold of you? And then two, what's like one message you would give to someone, whether it be financial, whether it be about lifestyle, just one thing. If you could just tell them one last thing, what would it be?
So my company is Cashflow Architects. That's the handle on YouTube and Instagram, Cashflow Architects. If you want to check out the book, which I would say go check out the book, it's The Entrepreneur's Asset. You get free audiobook if you buy it through the website. And one thing I would say, dude, that I wish someone would told me is that you have something inside of you that tells you that you think you can be great at something. You could be better than what you're being. Go after that thing. If your family's pushing you to college and you don't want to go to college, don't go to college. If your family wants you to get a W-2 instead of starting a t-shirt company on the side, maybe you get a job, but start that t-shirt company on the side. You will never regret trying what's in your heart. You'll never regret it. So you have to go after it. And everybody who loves you is going to tell you not to do it because they want you to be safe. Entrepreneurs get comfortable being uncomfortable. And when you learn how to invest in yourself and take action, there's nothing in life that's more fulfilling.
So good. So good. Guys, go follow Matt Love on, what was it again? The handle?
Cashflow Architects on all the stuff. And then the book is The Entrepreneur's Asset.
Go follow him. Check out the book. You'll get the audiobook, like he said. You're also going to get, I think you said a course?
Yeah, you have a financial blueprint course, which teaches what I call cash flow banking, how to replace your bank. Goes over retirement strategies. And then there's a whole community in there of investors. We have an investment group, too, that you can join.
Incredible. So go check that out, guys. It's been an absolute pleasure. Until next time, I love you guys.
Thanks, Devin. See you guys.